Hey, everybody. I'm Lucas Matney. I'm an editor at TechCrunch. Have been covering stuff in the venture world for a long time, but the stuff in Web3 defies everything I've covered before. It's chaos, but it's interesting. But I want to start by just kind of getting everyone's lay of the land, what you're working on, how long you've been in the space, type of stuff you invest in. Let me start with you.
Can we get another mic or two more mics so all of us are mic'd up, or Bob or John up? I'm Kelly LeValley Hunt. I'm the founder of Pearl River Venture Capital and Mint Gold Dust. Mint Gold Dust is an NFT platform. Pearl River is an investment company run by myself. So I'm the little tadpole on the stage.
Thanks for having me. My name is Jake Brookman. I'm the founder and CEO at CoinFund. We're a blockchain-focused investment firm, mostly in New York, Boston, and Miami. We've been in the space since 2015. We're one of the first crypto funds out there and been investing in all manner of blockchain and decentralization technologies since that time. It's our 7th year of full-time investing in the space. We have over 100 companies and projects in our portfolio. I'm excited to talk to you about investing today.
I've got my own microphone. This is really exciting. Hi, everyone. My name is Sutian. I'm a partner at Multitu. We are an investment fund that invests in diverse founders, where we're hyper-focused on that across a broad range of industries. We invest in funds and companies across both Web2 and Web3. I guess in terms of getting a start in crypto, I had started my venture career at a shop in New York City called First Smart Capital, where we were one of the first checks into digital currency group. And it's been a process of learning through that investment from there. In terms of, gosh, what were the other parts of the question? What we like to invest in? Yep. As I said, we're quite broad. What we're looking for are non-consensus, non-obvious ideas started by diverse individuals who see the world in a way that no one else does. So the question that we like to ask is, what do you believe to be true that no one else does? And if we can get aligned with that story, that's where we get excited.
Great, thanks, guys. I think one of the cool things about this panel is that we have a lot of people with kind of differing levels of resources behind them, or research teams, doing stuff on your own. The title of the panel is Finding Alpha. As a journalist, I spend a lot of time on crypto Twitter, spend a lot of time sliding into people's DMs on Discord. How do you guys find alpha?
I can go first. For me, it's fairly simple. This is my 5th year at ETH Denver. I invest in developers, typically, if I think it's a good idea, personally. And if I think I could probably take that to market, then I typically will get a little bit more information. If they have a protocol, I'd find out what kind of consensus algorithm. If it's a platform, I talk to their teams. I talk to the developers, how much knowledge that they have, what their skill sets are, how many years they've been writing code, for example. I think that's really important. And if I think it's an opportunity that I could actually take to market, then I typically try to invest. And if I can't invest, then I introduce other investors.
Okay. So we tend to be trend-driven and thesis-driven. In our firm, we have a lot of experience in the space and a pretty deep understanding of the technology. And what that allows us to do is to be early in the trends that are happening, and also to kind of be able to predict fairly well which are trends that are important and up and coming. So one really good example from CoinFund is that we were a very early investor in the NFT space. And one of the reasons is that it's a bit of a passion vertical for me. I'm a digital art creator, kind of all my life. And I saw Rare Pepes in 2016 on Counterparty, way before the word NFT was even a thing, and had this strong belief that one day this would come to market in a big way. In 2017 in November, when sort of CryptoKitties launched, I purchased CryptoKitty number 12 for like $4,500. People thought that I was crazy for buying a JPEG of a cat. And then in the summer of 2020, when many people were very focused on DeFi, me and Andrew Steinwald went on Bankless podcast, and we said we'd like to make a bold prediction. We think NFTs are going to be bigger than DeFi. It just like speaks to the consumers more. And sort of here we are in 2022 in early mainstream adoption of NFTs. So that's like one example. We've just been early, and there's many other verticals. We're deep in base layer technology, scalability, interoperability technologies of blockchains. We've been investing in Web3 since 2017. We were early in DeFi, like mid-2019. And there's a few other trends that are happening now that will be more important later.
So I think I differ from the two folks on this panel in that my institutional investing background mostly comes from the Web2 world. So it gives me a certain amount of perspective in terms of figuring out, okay, well, what worked in the Web2 world when it came to investing, and what has the opportunity to be changed or evolved for the better. I think fundamentally at Multitudes, what we're investing in are people, right? But what that means for us and how we also differ from a lot of other VC firms in the space is that we don't just invest in companies, we invest in funds as well. If you think about your network, right, it's a function of circumstance and it's a function of choice. And the people that you know, that's unique to you. It's almost like a digital fingerprint, right? No one else has the same network as you do. And so what that means is that you have insights that are unique to you that no one else does. It's the whole point around, okay, what do you believe in that no one else does? What that means for us is that within the Web3 world, we actually take a pretty strong view in investing in small funds where the founding partners, the partnership, has unique access and deep connectivity into networks that we don't, right? My background, I'm an Asian woman who's been in, venture for the last decade plus, and I just know the things I know, but that doesn't mean that those are the things that are going to be most generative for the world, right? And so how do we think about how do we invest in the folks who are closest to the action? And so we're looking at, we're about to invest in a fund that specializes in investing in DAO tooling. And for me, that's something I'm super interested in, but I know I wouldn't have the fidelity of decision making that this person does. And so we invest in these funds as a way to accelerate our learning and our connectivity in the markets that we believe will be big.
Yeah, and I think you're right, if I can add to that. If you work alongside somebody, like I worked alongside of John Crane and Charlie Crane, who founded Super Rare when they left Block Apps, which is the first blockchain as a service company that we took to market in 2017. We partnered with Microsoft, AWS, Google, Red Hat, the UN, anybody that we could partner with. When I worked alongside of them and watched them work and watched their integrity and their coolness, I thought they would be a good team to invest in, and which later on they founded Super Rare, and I said I want to invest, and I was one of their first investors. And I met Jake in 2020. I'm going to shill you for a minute, and I invested in Coin Fund, I think last year at $250,000. So my check size is like all over the shop. There's no like strategy or anything like that. That's probably your next question, huh?
No. I mean, well, on this point, I mean, there's so many options for you guys in terms of, investing in tokens, investing in NFTs, investing in funds, investing in equity, equity investments in startups, and I know that some of the bigger institutional funds are kind of fundamentally changing their structure so that they can invest in some more than other. Like, how do you make the decision on where you want to direct, this big pool of capital that you have, or, what decisions you make?
Yeah, the big pool of capital's right here, but so I have my own money. I don't take anybody else's money to invest, and so I think that I have to kind of sleep on it first. Unlike I don't have a team of people that kind of guide me in my understanding and my moral compass. I try to look to my peers for input. But more or less, it's just, do I think it's a good team? Do I think the technology's right? Do I think they can make it?
Yeah.
And also, can I sell it? And if I can sell it, then it's a good idea. I invested in a company called Gilded Finance, about $200,000 a couple of years ago. They do tax for wallets, and they do invoicing for paying your employees, for example, in crypto. They're based out of New Orleans. I'm from New Orleans, so I invested in them, and they're a cool team. So my check size is like $5,000 up to $500,000. So, and Jake, you have probably a little bit different pocket size. So.
Thank you. In terms of like tokens versus equity, so when we launched our very, very first vehicle in 2015, we kind of took a position that this is a digital asset fund. We want to be investing in digital assets. That's what differentiates us from other investors in the space, especially at that time. What we learned rapidly was that, these are not kind of binary choices like equity or token. What we learned was that there's a spectrum of ways that projects could structure. Like if you're a decentralized network, you're accruing value potentially in the network asset. If you are a infrastructure as a service company like Blockdaemon, you look very much like a traditional tech startup in an equity deal. And there are many networks in between that have native assets as well as proprietary equity-based businesses that add value on top of the network. And so what we learned quickly was that you have to be flexible and you have to be able to support a wide array of kind of mechanisms for exposure to different assets in blockchain. That could be equity, SAFTs, notes, convertible equity, and so on and so forth. Even like providing liquidity, and earning a yield could be an exposure to a network. And so, today we sort of exercise that, and we also see a lot of traditional investors now taking blockchain quite seriously, and some people saying, you know what, we're just going to do like equity deals in blockchain or something. My opinion on that is that if you're an investor in blockchain, in Web3, and you're limiting yourself to one structure or another, you're probably doing it wrong. There's a level of flexibility that you need in order to capture the value correctly of the things that you're investing in.
Yeah, and just right before you answer that, I just want to add to that, you have to be flexible. And if you're not flexible, you're probably in the wrong space. And I think that is really the key.
I was just going to say, like, it's a space of innovation on the technology side, also on the deal structure side. And you have, if you want to be, an investor in a disruptive space, you have to be a disruptive investor.
So we started as an equity-only investor, right? So we were one of those folks who were like, oh, okay, like I think this is gonna, this is interesting, but we're gonna look at it from sort of the Web2 lens of, okay, we are going to take equity positions in companies we find to be potentially unbounded in their upside. To your point, Jake, that doesn't really work, right? Because you're taking an old paradigm and trying to shoehorn it into this new ecosystem. So that's all to say that for us, it's a work in progress. We have not made any tokens investments to date out of the fund. One, it's not, there's a couple of things here. It's not because we're not interested. Intellectually, I think we find this, the fractionalization of upside opportunities to be really, really interesting. And by fractionalization, I mean the fact that you don't have to just take equity positions in companies anymore. I think functionally and from a regulatory and legal perspective, there's some stuff that we need to figure out on our side. And I do think that's one of the opportunities that gives folks who manage their own money, for example, a lot of latitude and a lot of speed to run ahead of the sort of more traditional VCs who want to invest more heavily in this space, because start conditions really matter, right? And so if you're set up 10, 20 years ago to do this certain thing, it's much harder to move the direction of the company, even a couple of degrees over, than if you're to start de novo today and say, okay, well, how am I gonna be set up and structured to take advantage of the opportunities and how I think the future will hold when I don't have all this sort of historical baggage that I have to account for?
Yeah, it's easier to, in my position, it's a little bit easier because I'm educating a lot of lawyers. I'm paying a lot of lawyers for me to educate them in this space, which is kind of makes me a little bit crazy. So anybody recommend some really good token lawyers? It would be great. I know you have a few that you can probably recommend. But yeah, in the beginning, that was one of the biggest challenges was the regulations. What was it going to become? And it wasn't a challenge for me because it's my own money, and it's kind of, I don't have to worry about as much as more institutional or funds because I'm not taking other people's money. But the companies that were issuing tokens when I was investing with equity and then eventually they would be releasing tokens, they were worried that the regulations would backfire on them or the legal implications would backfire on them. So we had to be kind of careful in the beginning. I'm sure you experienced that as well. But I think it's starting to become more, the framework is in the Web3 space, the framework is going in that direction. Do you want to add to that, Jake?
Yeah, I mean, I think so to your point, it's a process where Web3 is being adopted throughout the world, not just by customers, not just by founders, but also by investors. And today, what is the core difference between what we call a traditional investor and a crypto native investor? Well, I think it's just that. It's the ability to purchase your token, to participate actively in your network, to put in proposals in your decentralized governance system, to add liquidity to your decentralized lending protocol, right? And today, because crypto native investors are sort of specialized for these use cases, they are compelling early stage partners who can increase your network's probability of success. But over time, everyone should be doing that, right? This is where we're going with Web3. And so I do think that investors will update, and you'll see traditional firms launching, new and we do see that even now, starting to launch kind of token-focused funds. And it's really bullish for founders at the end of the day.
Yeah, I would add one thing to that, which is that I think in the Web3 space, there's an opportunity for everyone, not just people who are sort of traditional investors, to think about themselves as investors, right? Money is fungible at this point, and so the real opportunities are thinking about, okay, well, how do you aggregate attention, right? And how do you use time wisely? And what that means, though, is that instead of the sort of more linear model of Web2 investing, where LPs invest in funds that invest in companies that do stuff for consumers, and then the consumer drives value that goes back up to the company, that goes back up to the fund, that goes back up to the LP. In this world, you're seeing more of a circular economy, right? Where you have creators and communities and capital, but that capital can come from a lot of different places. And I think the bar for that capital is getting higher, right? No longer can you say, hey, I've got some money, I want to give it to you, right? The ask is, well, what else are you going to do, right? Are you going to participate in governance, right? Are you going to activate your community? Do you have a community to activate? And so I think the paradigm for what constitutes a value-add investor is quite different when you have this new model of, again, non-linear participation, but more circular participation in the Web3 world.
I think going off that same point, just talking about, how many big institutions have gotten involved, hedge funds, when you're looking at, Tiger or Coatue coming into a round, how does that kind of change how you have to kind of enumerate what your value add is to some of these startups and founders?
I'm going to hand the mic over because I don't take money. But I do get scared when I've invested pre-seed in a company and then they do a Series A with or B or something like that with Sequoia. I'm like, oh my gosh, I do get worried. But anyway.
Why so?
Well, they have stipulations. In order to get involved, they kind of, they throw the gauntlet down on some of these startups, and I kind of have watched that over the past few years, them get involved, and I say Sequoia, and I'm generalizing. There's other big players out there, and I'm constantly, thankfully, the people that I have invested in, they do come to me, and they do ask my opinion on things, and they'll ask, should we involve them? They've reached out to us. Sometimes I'll see them at an event and they'll ask me these questions, and I do tell them proceed with caution. It's kind of like a yellow light. Just make sure you don't give them the kitchen sink, everything and the kitchen sink. But I don't take investment. I just kind of advise my the teams that I have invested in going forward. So I'll hand the mic over to Jake.
Thanks, Kelly. Well, I think the first thing to say is. The first thing to say is that the traditional investor interest is net bullish, right? So there's a lot more capital in Web3. There's also a lot more founders coming into Web3. I mean, look, we're at a conference which is arguably the largest crypto conference since COVID started in the US, right? Right now there's more people in Denver than in Consensus New York 2017, which seemed like a madhouse. And we're 4x that or something. I used to work at Amazon, right? I took the Web3 route, I guess, earlier on, and I had a colleague there who was a technical product manager who stayed at Amazon for a while, and now he's coming into Web3. So why did this highly compensated technology professional choose to do it now? Part of the reason is because he feels like he can come in, it's a legitimate space, there's traditional investors, he can get funded, et cetera. On the other hand, the type of investor that you mentioned at that stage tends to be more of a passive capital kind of investor. Right. We're happy to be much earlier stage than that and engaging our companies very actively, helping them to solve the kind of what we call the full stack of problems that they face in blockchain. And those types of investors come in later as the business scales.
I guess just adding on to that, and we can continue on, but as you see folks like Andreessen kind of adopting a little bit of what Paradigm's model has and getting a lot of research partners on board who are kind of actively engaging with the community. I guess as some of those bigger funds may copy that, does that, and they kind of see what works for you guys, and then they have these multi-billion-dollar funds. How does that complicate things?
Well, I think that our strategy at CoinFund is not that we are trying to raise the biggest fund. Our strategy is that we want to be the top decile performers for our investors in every product that we do. And I think that when I hear about someone raising a multi-billion-dollar fund, that makes me happy because I know it opens up earlier stage capacity. The type of institutional investors that we have, they tend to write kind of big checks, 10 to 15 million, but not the biggest checks, 30 to 40 million. And what that means is that they prefer earlier stage vehicles because they get kind of a higher asymmetry on their money versus, a much larger vehicle that tends to get, tends to solve for capacity, but not so much return, right? So in some ways, it's actually good for our model when those investors move more upstream.
Yeah, I would say that, generally speaking, and this is, I think, something that everyone in this room would agree with me on, more competition is generally better, right? And certainly if you're a founder and there's more competition in terms of the capital providers to get on your cap table or be part of your early story, that's net positive. I think for a fund or for any investor, some of it just has to come down with being sort of honest with yourself, right? And thinking about, okay, well, what are your strengths, right? Your core strengths as a fund. Does that fit your strategy of investing? And then can you effectively share that story with the world? And if you can do those things well, what you end up creating, hopefully, is a moat. It may be a big moat, it may be a small moat, but hopefully you create a moat, a reputational moat around what you bring to the table, so that founders know that you are not trying to compete with a Tiger or a Sequoia or an Andreessen, right? There's something that you do that may not be for everyone, but it could be coaching services, it could be help on go-to-market, it could be community building, but something that you do that is valued in a different way. That's not to say, and the beauty of investing, certainly nowadays, is that as a founder, you don't typically have to pick one, right? You can have multiple investors around the table. And so in some ways, it's like putting together a jigsaw puzzle of saying, okay, well, what do I need help on, right? And this investor can do this really well. This investor can do this really well. This investor can do this really well. This investor can do that really well. And from an investor's perspective, really being able to crystallize your value add and have that be easily disseminated across the founder networks that you want to be a part of, I think requires a lot of focus on doing one thing well versus trying to cover everything and saying, oh, we're going to follow the herd and try to replicate some of the programs that we see working for other people.
Yeah. Well, I think we're kind of running out of time, but one thing I do want to end it with is a bit of a defense of venture capital and crypto as a thing. So, obviously there was a conversation kind of started by, I guess not started by, but one that Jack Dorsey talked about in terms of kind of like the centralization of some of these crypto platforms for, within Web3. But I guess generally, you talk to some decentralization advocates and they, look at things like pre-mines or big token discounts with a pretty skeptical eye. I guess do those themes seem pretty antithetical towards, what Web3 and crypto are in terms of, pre-mines, token discounts, stuff like that?
I don't know how to answer that. But I do want to, not to just completely derail that,
well,
but
let's keep on the question.
I do want to say that there's a lot of pre-seed people here that we really haven't really touched on. And I think that I'm tiny and I do worry about the people that are here and that are seeking pre-seed and that are seeking mentors as they move through the pre-seed and seed and Series A, but I'll hand over the mic to Jake, but because no, I think he's better suited to answer that question. I'm more suited to answer the things that are applicable for the ETH Denver, maybe the historical ETH Denver ethos, because now it's kind of moving into these, we're building, or we're further along than what we were, and now we're looking for Sequoia funding or whatever, Tiger funding. I'm kind of still used to investing in pre-seed and seed levels, and I really care about the community and making sure that they get funded.
So you asked if it's antithetical to the ethos. I mean, again, my answer is that it's not a binary choice between a token supply that is funded by VCs or a totally community-owned token supply. Everything in between is also in play. The key point for me is that this technology enables you to construct the correct model, and we see that in the market all the time. We see highly decentralized networks that make the choice to only get funding from their communities or public investors or crowdfunding. We have other kinds of projects that are building decentralized networks, but find that it is incredibly important to have the right set of partners. Like if you're going to convert the telecom world, right? You need intros to some CEOs of AT&T and so forth, right? So all those models, I think, are valid. Mm-hmm. Now, when Jack Dorsey, kind of says the things that he says without that much precision, I think a lot of that goes back to the idea that some of these token supplies are used as governance mechanisms. And if you have a governance mechanism with a concentration, then maybe that's not the most optimal model. But what we see also is that we're just at the beginning of innovation of governance systems in crypto. And we can solve those problems through technology, right? We can create like liquid democracy, delegation. We could do one token, one vote systems, and many other adjustments to governance systems that could solve those kinds of problems.
So I know we're at the end of time. I will keep this very brief. +1, everything he said. And the other thing just to keep in mind is that venture capital as an asset class or as a sort of product is a good fit for a very small minority of projects or companies that come to market. And so I think we all talk about VC and sort of the institutionalized capital markets. But one thing to just really think about is that there are a lot of other ways to build a business. There are a lot of other ways to fund your business or your project or your protocol. And to your point, Jake, Web3 allows for the flexibility to do some of those things with an ease and scale that we haven't seen before. So I do think we're really early in all of that.
Yeah, and to add a point to that, just sorry, I know we're running out of time. We won't get off the stage. I just want to add to that. These guys are like extremely intelligent and can guide at the further stages. At the beginning stages, what you need to make sure is your technology works, and you also need to make sure that you include the people that are going to guide you in the right direction, and not focus on the DAOs and the tokens and the Sequoias, the bigger picture. Make sure, at least for the first year, that you get your tech right and your team right and your advisors right. And that was my point in like kind of skipping that question, because I think for this community, and for the majority of this community right now is, thinking about how do we innovate, how do we create a new economy, how do we further this economy, how do we further this Web3, the future of Web3. And I think if you focus on your technology, if you focus on getting it right, if you focus on communicating with other people around in this community and getting good advisors, you're on the right track. For at least the first year, make sure that part is right. Don't think about anything else. Don't think about the tokens. Don't think about the DAOs. Don't think about, unless you want to just create a DAO to begin with, and that's your idea. I would really focus on the essentials and the foundation first. And I think that for me is that's what I always advise everybody.
Cool. Well, I want to thank our panelists for some great conversation. They're going to pull me off stage right now, so let's
come to the Mint
go.
Gold Dust auction tomorrow evening at 6 o'clock, you guys. NFT.